Hello, welcome. This is John Person. Thought I'd walk you through the trade we did this week in Costco for earnings. There was all kinds of things out there this week for everybody. Artificial intelligence, NVIDIA, all kinds of crazy things. But I chose Costco because I thought it was a fairly, not just safe trade, but I love the risk-reward dynamics. Just to give you an explanation, this earnings season when stocks get punished on bad earnings or slight misses, they get really punished. We've seen Enphase, ENPH lose, 30%. Estee Lauder gets slaughtered. Ulta Beauty didn't fare well either. The list goes on and on. But then stocks that have done well up until NVIDIA came to light this week, stocks that did well were up maybe 5, 6, 7, 8%. Well, Costco, I'm thinking that in the retail space, they've had 2 quarters of really good earnings. The last earnings announcement, they said, our sales are starting to taper off. Membership's still strong. People aren't buying big ticket items. So, we were looking for Costco, people still buying a lot of gasoline, people going and consumer shopping, and still driving people back for consumer staple items, food, meats, etc. So I was expecting a fairly decent report, but nothing spectacular. So with that, I thought that Costco got beat to Dickens. So this week on the 24th, the market fell, and I want to point out to you the chart pattern. So it's been trading pretty, near the $500 mark. Last month it was near 510. It's traded lower when it was at 505 and dropped down to about 493. This is a volume indicator here. It's a momentum of percent change of volume. It's not a actual volume. It's the percent change of volume. And as you can see, as the trend moves down, there's a lot more red bars in there than there are green bars. And that means there's more selling pressure. When the market rallies or moves sideways, it's not a very strong bar of green, and nor is it a lot of it. The next leg lower that took us from 500 straight down to Wednesday's low around 479 and change. Notice that the red bars were starting to be very minute. It was dissipating. So the selling pressure dried up. So I thought that was a good sign that maybe people that were long ahead of earnings got wiped out first. And I said, this is a good trade structure against weekly person's pivots. At 480-ish, it's a good trade entry. So so I wanted to explain the technical condition and what prompted us to buy. Yes, that's a PPS green arrow, which is a buy signal on Costco. So we did get an intraday buy signal as well as a sell-off on weak volume. So that was this technical setup that alerted me to wanting to get a position on. But knowing that I'm not a big trustworthy fan of a market on earnings, especially if we saw what happened to Wynn. They beat top line, beat bottom line, gave incredible guidance, and the next day the stock plunged. Why? People thought it was too good to be true, and maybe there was some China issues with COVID that could present a problem. So we've seen stocks have good earnings and still haven't worked. So it's been a very tricky earnings season. But with Costco, that's why I wasn't just saying, let's just buy the stock. But I did want to be engaged in a bullish position. I felt that it had fallen pre-earnings to a decent level and under the right conditions. So the straight strategy was I was willing to put up some money for this trade, bought 300 shares. But here's the takeaway. We didn't just buy 300 shares just for the heck of it. We had to work the order. So the shares didn't all get filled at once. That was probably the big problem with Costco. So I'll see if I can get all the data in here. We first got partial filled on 400 and then partial filled on another balance there. And as soon as I got filled on the partial position, what I ended up doing, which is the takeaway here, don't just go market on orders. You got to work orders. Look at your bid and your ask. I mean, we were running with Costco between a 20 to 70 cent bid ask during the day. So what that means is 70 cents, if at the precise time you go to the market and the bid or the offer expands to go long, to buy, you're going to get whacked at 70 cents. And if you're on a good size position, 300 lots, you just made the market makers some money. And they'll be doing this all day long to consumers and investors. So bottom line is you've got to work your trade. And that's the takeaway here. Find your analytics, work your trade, develop a strategy. The strategy is I wanted to be long, didn't trust the market, didn't like the options outlook. So I wanted to be in the stock. But then I took a kind of a customized collar strategy, let's call it. That's exactly what this really trade wraps with. long the shares, short an upside call with downside put protection. But we use different calendar months or different option expiration series. The first one we did is once we found out we got filled on the bulk of the trade, the partial position, I immediately went and sold the call that I wanted to be short, which was the June 16th, which gave me 2 weeks of time, which had a little bit more premium at 497 half strike. So we bought the stock, as you can see, at 482 and a half. So that's about $15 of upside between the stock and the strike price, $15. Not a bad percent gain, if it took 2 weeks to do. And if it took shorter, that's fine. We'll be called out of the position. I don't care. We collected $6. So we have really $21 in that trade to profit from. That's a nice gain if it worked out perfectly. But I wasn't engaged to try to make $21. I was engaged to make a directional upside trade. And I wanted protection of the downside. So what I did is, if the market was going to go wrong and things didn't work out, it may take time for the market to go up, maybe, but it would take no time for the market to go down if I'm immediately wrong. So I bought downside puts that expired June 2nd. So there's your calendar effect. And so I went with fairly close to the money, the 475. So I had credit of 620 to deal with. Notice in this case, I'm long 300 shares of stock. I sold 3 calls. So I'm 1-to-1 for my liability. What happens if Costco said they too were engaged in artificial intelligence and the stock was up 30%? I mean, I've been crushed having more short calls than long stock. So in this case, I don't want liability to the upside. I want downside protection. So 1-to-1 on the upside protection on the short call. That's generally my rule of thumb. On the downside, instead of just going outright puts, I'm like, they're pretty expensive and I can reduce the cost because of the event. What was the event? Earnings. So we know implied volatility popped. So if the stock falls, I'm willing to accept a 10, 15% downside move or more. And so with that said, I have premium on the upside to deal with and I have downside premium. But in this case, I upped the edge a bit for the percent of the amount of downside protection I had. See if this makes sense to you. Long 300, short 3 strike calls above the market, bought 4 put spreads below. So in case the market went down, I'd actually have a little bit more protection to the downside. Didn't cost that much extra. So ratio wise, I used time value to my advantage and I used ratio to my advantage. And that's how we work that trade. Now, again, here too, you'll notice there's a lot of Costco time frame. Look at the 24th. You can clearly see we worked the dickens out of putting all these orders together because nothing got filled immediately at our prices. No market orders were used, all limits, and we stood by until the order got completely filled. And that's called working your orders. So I hope that lesson embeds in your mind. Work your orders. Now, as we got into the Friday, which the market was up, and all of a sudden, it opened unchanged. It was really like a no-brainer. I'm like going, wow, this, I'm going to have to sit with a little bit of short call theta, and the downside put actions. We got until next week to figure this out for Memorial Day holiday, and that strategy worked out beautifully. I don't know what happened, but someone put a fire under the market, and then an hour after it opened, we started to see the trade move higher. So basically what happened is I said, well, listen, if the market's moving higher, I'm now in a decent profit of the stock. Why would I need the protection at this point? So the stock's trading around 495. So let's dump the put side of protection because we don't need it now because the stock's rallying. And so with that said, it's exactly what we did. About an hour into the open, we sold the 475 puts, bought back the short 465 puts, and at the same time, I'm like, hey, I'm going to just jam a stop in this. I've got a guaranteed $10 win and profit in the trade. Let me dump the short calls. So the calls were collected $6.20. We got out of them at $9. So we took a little loss on the short call option, and then as the stock started to move, we just trailed a stop. Now, here's the last part about this, which shows exactly what you need to do in trading in the markets at times. You'll notice that I wanted to, as the stock started to move up near $500, I'm like, listen, this is now a really good trade, and $500, 503 was the highs from last week. Why don't I get out of half the position and I'll trail a stop in the balance? Sure enough, what happened? My offer to sell out of half at 501.65 sold 24, partial filled, finally got filled on the balance, 102 contracts, so 102 shares. So there you go, 150 shares sold out on that trade. It took time to work the order. Not it's all filled within a minute. But until I got confirmation that my half position was executed, I was filled, then I went in and placed a stop and trailed a stop. So we ratcheted a stop up during the day. When the stock hit near 510, I figured, hey, it could break out 510, 515. I'm putting a stop under an intraday 5-minute bar low, 508.10, put the stop in, walked away, came back. I was filled. I'm out of the trade. Nice little trade for a little over $5,000 win. This is what took place for this one trade for this week using options. The takeaway here is to share with you, number one, using options to wrap around your stock position is a viable vehicle, and why options should be considered in your investment repertoire. It's not always about just options. It's about hedging positions and working the orders smartly. So if you can understand wrapping around what your parameters of your trade are, what your risk, what your profit targets are, and then say, listen, I'm willing to accept both outcomes. That's one thing. And then finally put that down, execute the trade. And that's the key. Execute the trade. And don't walk away until it's filled. You've got to work the orders. So bottom line, I guess this is a great video to share with you about what it takes to really put a trade on and take a trade off. It takes time, it takes work, and therefore, sometimes you get these decent results. So again, this is not a home run. It's a nice base hit. It's a nice little trade, but it just goes to show how to put the game plan all together. I wish everyone a great Memorial Day holiday, and I hope you enjoyed the video. And again, we'll put out more of the trades like this, which are decent hedges, whether it's a collar option strategy wrapped around a stock, which is something in this environment which might be very useful. Since implied volatility is pretty cheap, buying downside puts along with being long stocks a pretty decent idea. And if you want a little bit more premium out of selling upside calls, consider selling another weekly out option to get a little bit more theta value in your strategies. Thanks for listening, everybody. Again, I hope you enjoyed this video. We'll do some more. We'll see you next time.